All right, well, Happy New Year, everybody, and good evening for those that watch it on tape delay. Hope you're all having a great holiday season and getting ready for what will be probably a return of volatility tomorrow, is my guess. This is Jeff Scott, and whether you got here from watching my YouTube videos or you've been here before, again, welcome, and let's go ahead and get started. What you see on my screen is basically the view that I have out of my condo at my desk. Although it got a little darker now, but I picked a condo that I could look at the water. I always like looking out. It makes me calm, especially sometimes with the market volatility. Something calming isn't a bad idea. As I said in my YouTube video, and when I put the invite up on YouTube, this will be a continuation of the video that I did over the weekend, and I'm going to look at some things in review and kind of get an idea of where we're going, and then do my usual top-down approach. The disclaimer, as usual, is educational purposes only. Anything that's recommended is in the spirit of education, not investment advice. I'm a doctor, not a broker, and although George Roberts with HGSI is kind enough to let me do these, and he actually, when I do them like tonight live, I'm using his subscription for GoToWebinar. I'm independent. I don't get paid for this. I don't get paid extra if you sign up to anybody's program. So hopefully that means I have less bias than some other folks will do, and I paid for everything that I'm going to show you tonight. So obviously you can't do a program without talking about the fiscal cliff. And I wish these were congressmen falling over the cliff rather than bison, but what a mess. I mean, they should all be forced to go watch the Abraham Lincoln movie and see how he practiced diplomacy and how folks actually worked together even though it wasn't popular with both sides of the aisle. I'm not sure it's avoided. Frankly, I think I made a couple comments to my weekly programs. Not sure it needed to be avoided in that in medicine there is some draconian cuts that are built into the system, and every year us docs go crazy. It's called the SGR. And then every year, whether it's before January 1st or sometime in February or March, they back the cuts out and they redo things. And so we get around the issue of our fiscal cliff. So I figure that they'd get to it eventually. As you saw in the market, it probably does matter for them to get through it. And I've not been that closely watching things, but the last thing I heard about an hour ago was that the House Republicans were not going to pass it as it is, and they're trying to get additional spending cuts. Now, not saying that we don't need those spending cuts, but that may cause some craziness in the market tomorrow, at least at the open. Craziness different than what we saw on Friday. Now, the problem is, and again, I'm not a political person, and there's not going to be a whole lot of political slides, it ain't over yet. Even with this bill passing, and assuming that it passes tonight, because I don't think the House Republicans will have the kahunas to want to be blamed for everybody else's taxes going up. The debt ceiling, we're up against it, so there's going to have to be negotiations, discussions there. And the last time we went through that with an impasse, the market tanked big time. Obamacare, which I guess is politically correct because he said in a debate he liked the name Obamacare, starts to kick in increasingly, which means there'll be 20 or 30 million new lives that will be covered. Who's going to pay for that? Well, you are. Your taxes are going up anyways because of that. And you might argue that that's not a bad reason to pay more taxes, but that's personal, and I'm not going to go there. And then, frankly, what's the long-term impact of the Fed spending $1 trillion a year that we don't have in addition to the traditional budget to prop up the economy? So I don't think the cliffhanger goes away or the cliff saga is over, although the stock market acted yesterday like the world was all better. So I put this on my webinar Sunday. I added the things yellow. First thing is, well, it's still going to dominate tomorrow. It's not over. Whether we get a deal or not, there will be volatility. As I said, the debt ceiling issue is a big deal. Are we going to see compromise? And, you know, we got this funny thing through the Senate. I mean, I wonder who's going to be paying taxes, because $400,000 for an individual, $450,000 for a family, you keep the same cuts. So for most of us on this call, that probably means you're not going to see any change to where it's been, except for some hidden costs like increased taxes to pay for Obamacare, the Social Security payroll tax going up, and a few other things. What's this going to do to your portfolio? Well, yesterday, as it looked like a deal was coming, the dollar weakened. So you might see a flight to the dollar if it looks like a deal is not going to happen, and that would not be great for most portfolios. You know, the market can go up or down. I mean, they certainly like the rumor on Monday, will they sell the news? There was a lot of pundits who thought that we'd see a run-up with the announcement and the market will sell off if it's not a deal that is going to actually meet balancing the budget. Clearly, the sectors are going to rotate. Will the leaders return from tax loss selling? I think we started seeing that at the end of the week, where Apple had a little bit of a bounce. And the point on that, it was that you know, since this year, since the concern that tax rates were going to go up, people might be selling their winners, not their losers, because your losers are worth more money now in 2013. And a lot of talk about international markets leading. So I just saw something come through on one of my other monitors that the Republicans are now going to vote tonight. So I expect that'll make the futures look good, because I think what I've heard, and I think is probably a fair sentiment, some of the Republican congressmen along the lines that they don't like the bill, but they want the bill to happen. Oh, okay. All right. Just real quickly, can people just type in yes if they can hear me? I should have asked that a few minutes ago. Just type in a Y so I can see the chat box that I'm not talking to a phone that's not making any sense. George, I'm not seeing anything come through here.
Lots of yeses. They're okay.
So you're keeping them. Very good.
Yeah.
Thank you. All right. I just realized that I made the mistake of sometimes forgetting to record it when I do my webinars on my own time, and then I have to repeat them. And then the other thing is, I mean, let's face it, we're not going to fix this without substantial pain, which means more taxes and big spending cuts. And I think they watered down this fiscal cliff to the point where I was beginning to wonder if it's going to be enough to even fix what we had. So that's it on my politics. As I said, this isn't going to be a political program. Now let's talk about the market. You've all seen this slide before, and it doesn't change. I mean, I have my employees in my trading business. I'm the only real person. The rest of my employees are software tools. And just like I get continuing education as a physician, my software tools, I continue to learn how to use them, and I participate in various educational programs. So in fact, I'm actually going down to a VectorVest program tomorrow for the weekend in Tampa. So if anybody who's on this webinar is there, look me up. We can eat dinner together. So what do I need when I trade? I need a real-time trading platform. I use both Tradestation and Thinkorswim. I need something to analyze the market, which is to me where HGSI comes in. I use other tools to supplement that, including EdgeRater and seasonal analysis now with Magenta Trader. And then I've learned a lot from Ian and Ron, Ian Woodward and Ron Brown, and some of their things are free, such as Ron's reviews and Ian's blog. And I pay for the others because they continue to help my education, which is an important thing. I'm going to talk through how I do things, and you know, you don't have to agree with what I do, and I've had interesting comments, pro and con, over the last couple of years since I put myself out there and had these conversations. And I think it's important that you realize that I've learned from a lot of different people. And I've been involved in creating one or two things that were unique, but most of what I do I've learned from other folks. So whether it's Ian and Ron with HGSI, whether it's Alexander Elder and Force Index, these are his books here, whether it's William O'Neill, which is really my foundation of trading as a CanSlim investor, and then CanSlim on speed with Gil and Chris with their new book now just came out in the trading cockpit, which I hope to finish on my little visit to Tampa. Van Tharp with position size and money management and stop losses. Really shows doesn't matter what stock you pick, it's how you manage the trade. Bigelow is the candlestick guru that I like. And then for those folks that are thinking about how do you create 10 or 15% twice a year off of your portfolio and not really worrying about cha-cha-cha growth, you're worried about paying your bills. Ronald Bronke's got a number of books and some software tools about writing cover calls and selling puts and making money by renting out your shares. Lastly, before I go forward, I often make comments about buy list, buy list, buy list. What does that mean? It means nothing. It means I have a list of stocks that are attractive to me that I will be watching when the market opens. I update the buy list usually on a nightly basis, and I scan the market as a whole looking for things that are changing that look impressive to me on a given day. But reality is I follow these stocks in some auto trading platforms as listed on the bottom. Never Lost Trading, MarketGauge.com has some things. So I have things that will be traded automatically based upon opening range breakouts and other things. And then I have scans going on to help me identify stocks during the day that I might want to work with. So as usual, I spent a few more minutes on the presentation today than I've done of late because I invited a broader audience. I'm going to talk a little bit about 2012. I think there's some interesting things that I found on my review. I'll jump into the top-down investing update since based upon yesterday's market. Some shortcuts, maybe a little bit of time for other programs. And since this is live, you feel free to put questions in to George, and he'll ask me from time to time, and I'm happy to answer questions. And at the end, we can look at some stocks. I mentioned Ian and Ron. They really are the secret weapons of HGSI. And when I talk about things that newbies have never heard of before, Eurekas and kahunas and bingos and bongos, these are things that I've learned from these two gentlemen. And there are, on the website, which I'll mention in a second, there are some basic webinars if you get lost in some of the vernacular. Now, I mentioned I like education, and note to George, Ian, and Ron, time to update the website. The next meeting is actually in March, sometime around the 24th. It's in Palos Verdes. It's probably the best bargain you'll get for your dollar from an investor training. I know some of the people that I invited tonight may be at a different meeting in Orange County and overlaps on Saturday. So there might be an opportunity after that meeting to come up to Palos Verdes for Sunday and Monday. Certainly, I've been to twice a year for as long as I can remember. Some of it's camaraderie and networking, but a lot of it is just to get a few nuggets from the minds of Ian and Ron. They always seem to be producing new things.
The page is updated. Okay. That page is updated, Jeff.
Okay. The website, highgrowthstock.com, is the site that's really that most of the things I'm going to talk about today can be found at. And I've had a little virus taking over my things and putting advertising, so God only knows what's going to pop up here. But on the website, under reports, under my weekend review, you'll be able to download the videos that I do weekly. Ron Brown, intermittently, usually every other week or so, is doing a movie as well. A lot about how to use HGSI. Under the seminars, you can, still needs, maybe I just got in my catch, needs to move into the March time there. And the other thing is, unlike every other program in the market, you can actually download a free trial, and I think there's a link that you can use to the software, including data for a short period of time as well. Ian Woodward, under blog, puts out a blog every week, usually, sometimes every day. What I've learned over the years is when Ian thinks something's going to happen, the frequency of his blogs gets much quicker. On the website, there is a learning center, and in the learning center a number of other webinars that you might want to use and might be useful to you. So lastly, I always put this in there, be your own guru. Don't rely on anybody. Rely on yourself. And that's why education to me is important. That's how I let others influence me, is by teaching me. Investing is a business. Make sure you have the right employees, which to me are my tools in the software. Continuing the education matters here, not just the medicine. Trade the market we have, not the one they think you should have. Now, just in case you think it's safe to step into the market, the Mayans, however you spell it, had it wrong. We're still here. But will the Elliott Wave gurus get it right? And Robert Prechter, I pay to get his newsletter, and I've got some of his software. I don't think you can be much more bearish than this. They pushed this out early, but he felt that it was such a big story. He put it out earlier than it's due. The biggest top in centuries, Dow poised to drop over 10,000 points in the next 3.5 years. Like I said, the Mayans didn't have it right. We'll see whether or not Prechter does, but thought that was a pretty loud statement. So enough of the PowerPoint. See, we've got over 60 people on live. That's great, considering that it's a holiday. Let's go through the presentation. So a couple things that I did. Let me pick where I want to start with. So one of the things that I do is I take I save as an HTML and import it into Excel on the last day of every year, or New Year's Day when there's no trading. So I have an archive of what the stock market looked like at the beginning of 2009, 10, 11, 12, 13, etc. And then what I like to do is go back and try and understand how the market performed. So one thing you might want to look at is, how did 2012 compare from a performance perspective? And I'd say from my gut feeling it was a positive year, even though volatility from a VIX certainly was down, I saw some pretty good swings in the stocks that I followed. Strength in the market was in small caps. For HGSI-like investors, that's usually a very positive thing. The S&P 500 had a good year compared to the very flat year in the prior year. In fact, overall, I'd say the market had a much better year, except for the VIX. And the VIX is going to be contra to the rest of the market. So small stocks, with the Russell and the NASDAQ leading the way, the S&P 500 a little bit behind them, and the Dow was clearly the laggard. But actually, the interesting thing is, if you look at a 2-year performance, the Dow's up 11.5, the S&P is up 11.5, the NASDAQ's up 11.2, and the small stocks are up about 8.5. So over 2 years, it seems like the Dow has actually done just as well as the others. So I like to look at historical. I like to look at industries. And one thing that I'm well aware of, I guess I'm a self-proclaimed top-down investor, at least sometimes on the weekend. Sometimes on the weekend I think I'm more of a bottoms-up as I do my preparation work. And certainly as the week goes on, I do a lot of bottoms-up investing as well. Homebuilders had a great year in 2012. In fact, anything attached to Homebuilders seem to have a great year in 2012. So whether you were looking at home builders themselves, so construction, so you think of Trex, Eagle Materials, building products, wood, the things that go around home improvement retail, lumber liquidators, Home Depot, anything related to home building had a great year. Will that continue? From a macro perspective, why won't it? Everything you hear is slow improvement in the economy, housing industry improving. Those who've done my webinars from time to time know how much I follow healthcare. And whoops, I didn't want to do that. And such as the biotech. And I'll show you some biotech stocks that had a great year. So a great year for biotech. Refiners were another thing we talked about many times on my webinars who did quite well. So I like to look at what things led the market. Now, one of the things that was interesting is there were very few laggards this year. One that I probably jumped into early on was coal. Clearly something that was a mistake. Coal had a horrible year. Keeps trying to bump up. Take a look at Cliff and Walters Energy right now, though Cliff is both iron ore and coal. Every time they try something, they get swatted down. If you're a gold bug, it wasn't a great year for gold stocks. If you are into the online education, although they had decent moves off the bottom, it was a tough year if you were in Apollo or ESI or the other ones. I think Lopi seemed to do well near the end of the year. So a lot of weakness in certain sectors, but for the most part, it was a great year to be in the market. Unfortunately, most individual investors are probably still on the sidelines. Now, when I look at stocks, you may have noticed when I put my warehouse view in play, and if I look at perhaps all securities, I always go to a scorecard, no index. And on Ron's, he went to a little bit scorecard and demand, so he's changed it up a little bit. And I like the scorecard because the scorecard ranks things, locates top stocks to trade based upon a mixture of technical and fundamental factors, strong earnings and revenue growth over the past year, strong relative strength, group rank, accumulation, return on equity, etc. So that is how I rank my stocks. Now, I also, you notice there's only 2,703 stocks there, and that's because I put a filter on. So it starts with 7798, but by the time I get to my scorecard no index, it's dropped down to 2703. And that's because the filter that I use here eliminates less than $5, less than 150,000, and is a group index no. So I don't want to even look at things that I wouldn't trade. Now that means I might lose some tiddlers along the way that would have been a good thing to buy. Now if I take those 2,790 stocks, in fact I did that, I can rank them, and these are looking at the end of 2011, so I'm looking at 2012 going forward. I can rank them by many different ways. I could rank them by ERG, and if you're a can slimmer, that's got the EPS rank, relative strength rank, and group rank. Or I could rank them by the combo, which is what I showed you was that scorecard, which has a mixture of technical and fundamentals. Now, one question has always been that one of the things that Ian has taught us is you buy the leaders. And so you might wonder, is that a smart thing to do? If you buy the stocks that have been the leaders, that don't you risk that those are not the stocks that are going to lead going forward and they're going to underperform? So I did a couple of things for you here. And if you've been to my webinars before, you haven't seen this. I looked at taking the stocks based upon how they ended in 2011. And I broke them up into 10 different boxes. And I broke them up based upon either 10 tiers of the combo rank or 10 tiers of ERG. So in the case of the combo rank, you divide up, there's 2,700 and change stocks here. So there's 270 in each decile. And then I did a group performance analysis. And what I found was, if you looked at the performance by where they ended up 2011, and then kept them in that group, and what was the performance over 2012, I found that the leaders for 2011 did the best for 2012. So the S&P 500 was up 11.68%. And if you had bought just the top 10% by scorecard index, even though they were leaders last year, they were leaders this year as well. And 2/3 of them were winners. Now the interesting thing, or not a big surprise, is the losers from last year, 2011, were by and large the losers of 2012. So laggards stayed laggards. So you didn't see huge rotation of the whole group where the dogs of the Dow type theory were the worst of the prior year, were the best of this year, although not too shabby on them as well. It was a good market. I don't know how to explain Tier 8 moving up so much, so I did go down and look at what was in Tier 8, and I think you'll see right away that there were a couple things here that made a big difference. It had some home building stocks, and it had Bank of America as two of the stocks in the group, and you could see it had 4 stocks, including Marriott and Brown Shoes, that had over 100% return. So even though it had Mellanox, that was a big mover early in the year as well. So even though it was lower on the list of performance in the prior year, it actually did better than some of the others. But still, the philosophy that leading stocks do well as demonstrated here, although 2, 3, 4, and 5, 2 and 3 and 4 are substantially below it, they perform very close to the S&P 500. So leaders led if you looked at scorecard. What about ERG? Does buying high to go higher work for ERG as well? And an interesting thing here, again, if you look at everything from the green line up, really from the white line up, there really isn't that much separation. Tier 2 and 3 by ERG, and that starts at about 240 and goes down to about 170, would be the second and third tier out of the 10. If I remember correctly, they actually outperformed the top tier. So that probably deserves a little bit more of study and looking at past years, but perhaps when you get to the 99 EPS rank and relative strength and group rank, you can't really move up. So, but again, the laggards remain the laggards. So I guess the message here is, if you want to know what's going to do well in 2013, look to who the leaders were in 2012. And don't buy the laggards, because in both groups, the lower half, whether we looked at the combo rank or the ERG, underperformed the S&P 500. So then I wanted to look at something else. And no question why Tier 2 won, by the way. It's the 6, at least the first 7 of these, we talked about almost every week on my webinars throughout the whole year. And Pharmaceutical, which was one of my favorites, which I didn't get the whole run, and Affymetrix, which I got a bigger run because it actually ran up to 24 before pulling back. So another thing I'd like to look at then is who were the leaders? And, again, trying to understand the market we came from, because my last 5 or 10 minutes of research hopefully proved to you that buying leaders as we ended the year are likely to be some of the better stocks performing going forward. And again, I say as we ended the year is probably not fair, because these were leaders based upon the complete year's performance, and I didn't weight anything towards the last quarter. So another thing to look at might be how many of these stocks did you look at, did you own? And what I've done is I've looked at performance by, I think, all the stocks that make it through, about 2,500 stocks that make it through my scorecard no index combo. And I looked at the return, and I want to know which ones of these did I not know about, which ones of these did I buy, which ones did I make mistakes on. Now, a couple things. I've also looked at their performance in 10, 11, and 12. Pharmaceutical sold off pretty hard this past week. Now, it turns out I'm not surprised by that. And the reason why I'm not surprised by it is, in fact, let's look at this. Let me see if I can do this on the fly. Someone did it for me earlier today, and then when they told me what they did, I figured out what I had to do. So I'm going to do some real live Excel work, and that means it's not going to work. Put this table array here. I made a table of performance over the last 3 weeks. I guess it's the second and false. So hopefully I'm going to populate now a column that's going to tell me it's not what it's supposed to do. Let me see what I did wrong. Last 3 weeks, column. Let me just try it one more time. If it doesn't work, then I'm just going to give up. Now, it worked earlier. There it is. Nope. All right, so I'm going to insert. I guess note to self, don't ever do things on the fly. So formulas, lookup and reference, VL lookup. I want to look up this value. Table is here. I know what my mistake was already. I think it's a 1, and then it's a false. Helps if I spell false. All right, I give. What I was going to show you is that, oh, I just remembered something. I already got that in here. Hold on. How about if I just unhide it? You can see that Pharmaceutical actually traded down 5% over the last couple of weeks. It might be worthwhile to, thinking about it, to look at who were some of the big run-ups that underperformed the last 3 weeks, because they might be those stocks that, as I mentioned, people were selling their winners because of perceived higher tax rates. And some of these, like Pharmaceutical, like Affymax, like Regeneron, I'm not going to talk about AIG, nothing there. Delk, one of those refiners which had a big move. WAC, some of these were really big movers, Medivation, and perhaps some of the sell-off that we saw over the last couple of weeks was tax gain selling. So I know from the webinars, and those that, you can go back and watch if you haven't, we talked about Pharmaceutical, we talked about 3D, lumber liquidators. I didn't talk much about Haemonetics. Spark Balance, I don't think we talked about. External Holdings. But as I go down this list, and I think those that have been on the webinars can verify, there's not a whole lot of surprises there that we never talked about. There are a lot of stocks like Pharmaceutical that have had multiple years in a row of great performance, but that's not necessarily the norm. If you look at home builders, for example, home builders had really lousy performance in 2011. Ryland had lousy in 11 and 12. 10 and 11. KB Homes lousy in 10 and 11. Over here, you can see some of the industries that were represented by the big moves. And I've got this spreadsheet. We'll look at everything in the market that was above $5 and 150,000 shares. So I like to look at this, some to beat me up, but more of it's because I like to see how many of these I actually owned. Look at Pulte, for example, minus 21, minus 16, up 155%. Did you see that coming? Did you catch them? Did you make money on those? And where are these going to look like next year? Look at CVR Energy. This has been on our screens constantly, constantly. Look at those returns over 3 years, 91%, 23%, and 132%. So I got to tell you, when I look through these and I think about the stocks that we talked about over the year on my webinars, it reaffirms to me that top-down investing works, because the vast majority of these are stocks that I've either owned or have talked about on the webinars. Now, when I did my group performance analysis, actually I have to look and see what the futures are doing. I guess nothing yet. Thought they opened. When I did my group performance analysis on over the weekend, I looked at the last week of December, and remember how red it was, how the S&P 500 was at just about minus 2% Friday to Friday. Well, I looked at it again after yesterday. If only all days were like yesterday, if you were long. Everything's black. In fact, there were no loser groups on Friday, on Monday rather, which just, there was some major exuberance in the market. The S&P 500, where is it? I forgot to color it, which makes it always fun to figure out. I think it was up a lot. It was up 1.69% using this methodology. Weighting is different. So it may not be the same as what you see on the major indices, and from the timing that I looked at it. But you had selections like the breakouts, just two stocks up 6%. One stock was a big winner, which was Herbalife, which got killed the prior week. The Tim Higgett filter, also a small number of stocks up 4.48. But IBDs, or MarketSmith's top 150 by relative strength, 112 up versus 5 losers, up nearly 3%. So technically strong stocks really had a great day on Monday. I just hope it wasn't a buy on the rumor and sell on the news thing. The other thing that I had introduced on the web, which I may talk about some tonight, is another thing that I'm trying to use with my analysis is looking at green candle lows as a potential swing signal or buy signal. If you think about a green candle, that means the stock closed higher than it opened. So if I set a low for that period of time, and then I close higher than I opened, then I have a green candle low. And I've done a lot of reading, and I'm becoming convinced that green candle lows might be a nice signal to look for during the day to try and identify stocks that I might want to buy and sell. George, any questions before I move on? What do I import? Okay, perfect. What I import is I go into warehouse, and of course I changed my mind a little bit and added. I didn't have boxes last year. If you look at in the view, you can see all the fundamental figures or findings that I will end up with in my spreadsheet. So I take this, and if I really want to take a wider view at the end, I'll take no filter. And then all I have to do is file, save as HTML, all securities test. And then I go into my Excel. It's so easy, and we just open up a new one. And I'm going to find on my desktop what I just saved. And that should pop up there. So now I have, for archival purposes, the entire market, a snapshot as of today. All right. So that's, whether or not this is useful to you on the webinar or not, everything is, is your own things that are what makes sense to you versus me. I like to have a good understanding of where we've been. Those two GPAs that I did looking at combo rank and ERG were important to me because a very important foundation of HGSI and the learnings that I've had from Ian and Ron have been, you buy the leaders. You don't look for the laggards, you buy the leaders. And I think that those studies, at least for the last year, validated the concept of buying leaders. And I've done this in past years, and they also validated that. So now let's take a look at the market. Now, unfortunately, this future speed is a little bit delayed. I thought the futures opened up at 8. They must open up later. And I'm getting a lot of comments about the vote coming in. And I don't know why that says Abbott. It should say ES on the 15 minutes. So let's just go and do that. This to me is a straight line up. And in fact, when I did my webinar, I commented how on Friday, after the market closed, that we saw a huge sell-off. And so here's a bar at 4:15. You can see the deep sell-off after the close of the market, and then it traded sideways. And then on Sunday night, the market continued to trade sideways, but the market closed up in this range, and this was a 12, 13, 14-point drop. And as you might notice here, it was in free fall when the market closed. And this was because of the concern that they weren't going to pass something. Back on the 21st, I don't know if I'll get, okay. On the 21st, we had another issue, and we had the issue of Republicans. See this flush that occurred after hours? This is when Boehner got up and said that Plan B wasn't going to be voted upon. But how quickly, by the time the market opened up, had really pulled back up and did fine. Well, the market was living here. I believe this is the drop that occurred from Plan B, and that became resistance overnight. And then sometime early in the morning, before the market opened on Monday, before it became clear, or when it became clearer, rather, that the fiscal cliff was going to be fixed, and I put big quotation marks around fixed, the futures took off in a straight line. And they closed pretty much at the high of the day. So I covered any short positions I had probably in this area here, and closed off my ETFs. I bought some of my short ETFs at the close at the end of the day on Monday, which will probably get burned if we sign and go crazy tomorrow. I just don't believe it. I think we're going to come back down. So I don't have any futures yet to talk about. So I like to look at what the market is doing, and let's take a look at where the strength was everywhere on Monday. Sort of skewed really from a typical presentation because it was such a unbelievably positive day.
Hey, Jeff, before you go, there's a question about what program you're using.
That was Genesis Trade Navigator. I kind of have a problem. I've not met a software program that I could say no to. So I actually have become increasingly fond of Trade Navigator. Its charts are nice real time. It links into multiple trading platforms. And unlike Tradestation and Thinkorswim, all I got to do is send their customer support a request, and they program an indicator for me for free. So, and I think the reason why I put it up there was it was so clear. Genesis Trade Navigator. What I've done now is I'm looking at the Major Markets Plus, which is in the Woodward and Brown groups, top-down analysis. Now, unlike Scorecard, which was balanced between technicals and fundamentals, this is all about price movement. It looks at one-day movement, which is heavily weighted. It looks at five-day movement, which is less heavily weighted. And it looks at force 2 and 13, which is going to give you closer to 2 to 3 weeks of waiting, less than the 1 day. So it's all everything, and then accumulation distribution. All this is technical stuff. And so this is a pure technical. It's not in the moment because it does look back a couple of weeks, but it gives me a nice feeling of what the market is doing and where the strength is. Now, I mentioned the year ended up strong for small caps, and the year started out nicely for small caps. Small caps 600, NASDAQ, NYSE, which has got a lot of stocks, Russell 2000 at the top, the 100 and the 500 near the bottom from the ranking module. Volatility got hammered, as did bonds, with the dollar falling and the flight into stocks on Friday with the big run-up. If we look at one-day performance, everything did well except for volatility and bonds, and the dollar really was flat, but it fell from earlier levels as it became clearer that things were going to be done something was going to be done towards the cliff. 5-day performance, not nearly as pretty. Oil and gasoline and silver and other commodities at the top, and the markets themselves trading pretty much flat line or below over the last 5 days. Funny thing is, I bet for a lot of you, Friday and Monday canceled each other out. And a lot of folks who were overly long on Friday had a bad day, and if they were still overly long on Monday, they made up for it. I like to look at certain industry or certain indexes before I move forward to get an idea of the market. I usually start with the NYSE composite, and I like the NYSE composite, and I don't like that view, because the NYSE composite looks at, it's a big index, I think it's like 4,500 stocks or so, and it's got small stocks, big stocks, a lot of different stocks in it. I gotta remember which is the one I want to use. This one is the right one. Well, we'll see if I got what I'm looking for. So just a few for those that might be new. These are momentum indicators. Green is good, red is bad. One of them has accumulation distribution. The top is the bongos, which I'm not going to talk much about specific indicators unless I respond to questions. This is the force index. I think we can hide these two things for tonight's purposes. This is the high jump bar, which I will talk about. Suffice it to say on the momentum is I like to buy pullbacks. So I want the long-term momentum indicator to be positive, in this case green. The short-term indicator is red, And when that turns green, I know the pullback has completed. So this was a pullback with the red bongo on the daily, which probably turns green tomorrow if the market trades up. I want to find those. In the force index, you also see evidence of the pullback. This is the longer acting and the shorter acting. The high jump is something I learned from Ian years ago. If he had found a way to patent this and then sell it to everybody as an add-on to other programs, he could have made a lot of money because this thing is worth its weight in gold. It's a rubber band for the market or for a stock. You think about a rubber band, if you pull it too hard, one or two things happens. It snaps back or it breaks. So the stock market's the same way, and whether I'm looking at an indice or an index, a sector or a stock, if you take the closing price and subtract the 200, the closing, subtract the 50, and the closing and subtract the 17-day simple, you can then add those three numbers together and plot them. And when you get to the highest high that it's been, you get to a point where you can count on the stock market either pulling back or going sideways. And as I look at stocks to buy and sell, I'm routinely looking at this high jump bar and understanding whether or not it's safe to get in or not. And I even take it one step further where, whoops, that wasn't what I wanted to hit. Plan on doing that later. I'll look in Tradestation, for example, and I actually will look at, try to think, where did I put it? And Sue's. I actually, I know I've got it in the pivot. I will scan for stocks that are extended by the high jump as I start to look for shorting candidates. So one thing that I might do is look for stocks that are high up on the high jump. And we'll go look at one and see if it actually looks the same. In HGSI, Ford, for example. And if it had a red candle high and a high jump that was extended, that's telling me it's setting up to short. So Ford is obviously not something I'm going to be shorting anytime soon. Maybe I am. It's a great stock. It's had a great run up. It's not a red candle high, but you notice it's the highest high that it's been. And I look back either at 200 or 300 periods in defining my high jump. So I want to, I don't buy stocks here because this is a signal that says Ford is either going to go sideways and let those moving averages catch up to it, or it's going to pull back. Ian, if you ever listen to this, I owe you because this one's made me a lot of money. We go back to the indices. So the NYSE we started with, I was going through what's on the chart. A few other things. I'm a moving average fan. Purple or magenta is an 8-day exponential. Stephen Bigelow calls it T-line. The green is a 17-day simple. The blue is a 50-day simple. The red is a 200-day simple. Down here, we have volume, and the reason why you see it twice is because sometimes it's hard to see it behind some of these dark bars. And these dark bars represent certain things in HGSI lingo. For example, this is a eureka. A eureka is a follow-through day in HGSI, similar to what O'Neill terms a follow-through day in IBD, and it represents exuberance in buying. Now, eurekas at a low or after a trading range often signal a run up. So that would be a bullish characteristic in this market if the market continues. The eureka and its red and maroon partner, the Phoenix, which is a negative exuberance, are calculated on the NYSE only and give you an indication of the market. I'm going to hide force kahunas for tonight. These are what we call kahunas on the bottom, and kahunas have to do with a big movement of the stock. And again, more momentum indicators off of some work of John Bollinger as advanced by Ian Woodward and Ron Brown. And blue is bullish, red is bearish. So if I look at the NYSE, pullback in action, mostly green up top, not near the top of the high jump bar. Very bullish day after a pullback, getting above its 8-day and 17-day exponential moving average, not touching the 50. With the Eureka and a kahuna, except for all the crappy noise in the background from the news, that is an extremely bullish-looking index chart of how I look at the market. And you can see it's had a nice run up. Oh, look at that. High jump bar hits. Stock goes sideways, pulls back, runs again. It looks to me, if there wasn't this overhang, that maybe we would see a January effect and the NYSE would run. Let's take a look at big stocks. S&P 500 won't be as pretty. It's interesting, as you could see, some redness up here, nowhere close to the high jump. You can see back here it got to the top. Here it got to the top, and what happened? It pulled back. There are some evidence that the same impact as the high jump is true in reverse. So you can see on the S&P 500, the lowest low was truly the lowest low. Now, again, a run up, a little bit deeper pullback here, very bullish candlestick on Friday with a kahuna here as well, taking out the 17-day. Now, I thought it was going to trade down to the 200 and then bounce from there. This is bullish if it can hold. Now, I expect it to trade back and retest the 50 before it runs, but it doesn't have to. If it can stay above the 17, very bullish. If it can stay above the 50 and bounce, also bullish. And maybe the cliff in the market has been avoided. A lot of people are calling for a big correction here. You've got that, you've got the cliff nonsense, and you've got the January effect. Now, the January effect is small stocks, and one thing I've learned is the January effect usually starts a little bit before we get to January. And in fact, if you look at the Russell 2000, looks just like the NYSE did, with the pullback to the 17, a big up day on Friday, again a kahuna turning green up here. And you can see you've had a pretty substantial run-up in the Russell 2000. So the January effect starts in November, 29 periods up 11%. So we had a January effect already, and I think this isn't the first year that it started early. So again, out of context of what's going on in Washington, hard not to be a little bit more bullish after what we saw on Friday. A pullback, pretty much the 17, and a ferocious day up. Now, what is there not to like? The volume was, there's no volume on this one, I'm sorry. You know, are we getting enough volume? And that's been one of the challenges that we've seen in the market. I didn't look at the volume on Friday. I got a feeling that volume was probably better than what we've seen. Let's see, what was it here? It was, volume was in the NYSE. I'm gonna find, because I don't believe it. That must be 3 billion. Well, I'm going to leave the volume alone. I don't see a huge volume spike here. That's disappointing. So that was the Russell. We looked at the S&P 500. Let's take a look at the NASDAQ. And then, again, the NASDAQ had pulled back a little bit more, had taken out the 200-day moving average. This was a big deal here. This day here got back above the 17, back above the 50. It'd be nice to see the 50 cross above the 200 and heal. As you can see, it's still got some red in the weekly bongo. So this is one that doesn't look as healthy, but to be honest, that was such a strong day on Monday. If I call it Friday, I apologize. I'm used to these on Sunday. that it's hard not to scratch your head and want to feel a little bit more bullish. But as I said earlier, there's a lot of background noise. The Dow, I said the small stocks were leading, so one might expect the Dow to not be real strong, and it looks a lot like the NASDAQ, where you've had a pullback that undercut the 200-day moving average. But you had a green candle low on Friday with the kahuna, and you could see here some of the technical damage showing a lot of red up top still. Small stocks are leading, as we saw from the top-down approach. Now, I often like to get the best feel of the market, look at the S&P Composite 1500, because this is great because it's got the big guys at the 500, the medium guys at the 400, and the little guys at the 600 in the single index. And we could see sort of in between the NYSE, NASDAQ, and Russell look, and then the big guy look, which is pull back not to the 200-day moving average, huge positive day and a pullback on Friday. Look, we get a cliff, we got a few more days running, and I'm out of my contras a minute after the market opens tomorrow. But I think we've still got too much volatility before I could say what I'm doing in tomorrow. I like to look back at Tradestation here and look at some of the elder indicators, and I like to look at the NASDAQ and see what elder is telling me. And elder, well, you could see, Ian commented on the number of boxes that went positive today overnight between Friday and Monday because of the movement in the market. And you could see in the NASDAQ went from red to green, green on the weekly, green on the daily, blue on the monthly. And those of us that follow Elder know that he paints them green when you can buy them. He paints them red when you can sell them. You can't buy when they're red and you can't sell them when they're green. When it's blue, you can do whatever you want. Those that follow Elder will probably also notice something that is not real attractive that I see here. Hold on. Trend line, where is it here? I don't like this. I can't draw worth beans, but what I'm trying to show you here is that we have a negative divergence on that MACD. So you made a higher high here. That was really pathetic. Higher high in the market, and you didn't make a higher high in the MACD. That does not say a lot for the likelihood of this being a positive movement, although maybe we'll get enough buying pressure in that we'll get a bigger peak. But that's a bearish divergence. By itself, it's not enough to tell me anything. It's just enough for me to be a little bit concerned. All right. So I've looked at the market. Let me see if this is showing anything on the futures. And we're still where we were, so the futures must not be open yet. All right, so any questions or comments on the market, George?
Nope, you're good, Jeff.
All right. So after I've convinced myself what way I think the market's going, and I really haven't convinced myself of anything yet except that the news is going to drive it, I like to get an idea of where the strength of the market is. Now, before I do that, sometimes or every night I'll look at EdgeRater. And with EdgeRater, I help to build the story of what's working and what's not working. And this is something that Ian and Chris put together, Chris White being the proponent, the proprietor of EdgeRater. And it shows me that at the close on Monday, 68% of the stocks in the S&P 1500 were trading above the midline in the Bollinger Band. 80% is bullish. 68, though, is a lot nicer looking than 40. So we had a very substantial move up off of on the percent V. what I note here is that the average peak here is at about between 70 and 80%, and that still tells me I've got room to go up. On Friday, it was the opposite. Friday, you had 7% were trading below the lower Bollinger Band, which starts to get me to pay attention. 60% were below the midline. And example of an extended market is if you go back to 12/20, 83% of the stocks were in the top half of their Bollinger Bands, but more importantly, 25% were above the top. And since 95% of the time the stocks live above or within their Bollinger Bands, if you're going to spend 90 or 95% of your life within the lanes, when you're outside the lanes, odds are you're going to go back into the lanes. So this to me is a topping or a time for us to see a pullback, and we saw the pullback in the market. I'm not seeing any evidence of that right now. So I will sum up: nervous about the news, liking the pictures, not counting this market out yet, but very concerned about the fiscal cliff and whether the vote happens tonight. Look, my bet is the Republicans have no choice, that they'll vote it, they'll accept it, they'll make comments about not enough cuts, and then when it comes time to extend the debt ceiling, I think you're going to see the Dems ask for more taxes and the Republicans ask for more cuts. I think that's when you're going to see the true horse trading. I think this fiscal cliff became a CNBC serial episode. After I've made my thoughts on the market, which are as clear as mud, I like to look at where is the movement in the stocks if I wanted to go pick some of those industries. And I go down to here to industry groups, and we see there's 145 of them, steel being the best with Homebuilder's number 3. The problem with that is it's looking at, remember that top-down, sort of a balanced over 2 or 3 weeks, pure technical view. I want to know what's working now. So I look at a 2-day force. So this is what's happening in the last couple of days in the market, and you could see what a change from Friday when I had about 10 groups that were positive and the majority were negative. And the vast majority of the groups are positive, 99. That tells you a little bit about the exuberance and the strength of the market. And for a high growth person, this is kind of exciting because there's a lot of things that we like. So let's take as a top-down approach, let's look at the top 10 or 11 and see if we can't find some things that Jeffrey's going to put on his watch list for tomorrow. Other diversified. So force is price and volume driven. The banks have more volume than anything. Look at the volume on these guys. 159 million average for Bank of America. They're always at the top. If the stocks are up, they're on the top of the good list. If they're down, they're on the top of the bad list. They're always in the same order. And Bank of America has been a superstar in 2011 with Elizabeth Warren on the Senate banking committees. Will that continue? But is that not a beautiful chart? A little loose, I'll take it, but something happened in August. It tightened up. You had all the moving averages aligned the right way, and it's driven right up to 50 and now up to 17 and 8 exponential. And let's bring in earnings now. Let's close this up a little bit. And you can see that this is a stock that has tested the 50. Now it's running up the 8-day exponential moving average, not at the top yet on the high jump bar. Technically sound, fundamentally, it's a bank. Still has a lot of external influence on it. Is this a leader? Absolutely. This is from 7 to nearly 12 in 4 months. What did I say at the beginning of the show? Leaders continue to lead. We'll skip Citicorp and look at JP Morgan. Not as exciting, perhaps, as Bank of America. Perhaps in a better position if I was looking to buy something with sort of a small pullback here to the 17-day, clearly not as extended. I think this is a sector to continue to watch. They have been leaders in the market of late. one might expect them to continue to lead if the market goes up. Semiconductors, this is a change, all right? On Sunday, I talked about how these were weak, but would we start to get interested in what was a 4.4% dividend on Intel? Well, somebody got interested. Now, it's right up against the descending 50-day moving average. I don't like to buy stocks, even though they look good. I think I want to be on a different, let me just check something else here. All right. Unfortunately, all my things say Jeffrey Scott on them, and I'm looking for a specific one, and not it. There it is. All right. I know it looks the same to you, but I know that pocket pivots work both ways on this one. So in a downtrend, looks ugly. Why do I like moving averages? I know I sound like a broken record. The 200-day held. The 200-day held. It broke. Gave a little bit here, and now we've been underneath that 200. And now the problem is we got to get above and stay above that 50. They act as support on the way up and resistance when you're down trying to get back up. So support becomes resistance, and hard to be excited here, except that was a big move here at nearly 2%. What was exciting, as I mentioned, was a 4.4% dividend, and these might be a place to look at in 2012. It goes against my buy the winners philosophy. Cirrus Logic has great earnings. I talked about this on the webinar. Not nearly as damaged as Intel. Kahuna's on Friday. It's got to get above this point, but that's only $3 from here. It has a multiple of 17 and a growth rate of over 100. I'm willing. I don't know if I want to be early on this one. Do I want to wait for it to get above that 50 and that 200? But if I wanted to buy semiconductors and I didn't care about my dividend, Cirrus Logic looks to me like it's going to head up. Broadcom's sort of in a similar position. Things have all turned green here. It's a little bit below its 200-day, which has been resistant in the past. I'd like to see it get above it. Nowhere close in the earnings growth potential. I hate Micron. It's really been sideways for a while, so I'm not going to say much about Micron. So a little bit of life in the semis. Probably the first three are the ones to pay attention to. And Intel, if you want to bottom fish and get a dividend, and Cirrus, if you think it's going to break out, would be things that I'd look at. Computer hardware, that's a funny one to see here. Well, why? Because Apple, big volume, big move the last couple of days, well, the last day. Now, is this the end of the fall? Is this the end of the tax gain selling? And are we going to go back up to 700? Not if you listen to the pundits. That's probably why it might happen. It's got to get through the 50 and the 200, which are likely to cause formidable resistance. You see what the 200 had done here before. It wouldn't shock me to see it trade up to the 50 and roll over, and then you're going to have yourself a head and shoulders set up. And I know Gil has talked about this and Priceline and others maybe setting up to short. That said, if we get a cha-cha-cha market here because the guys in Washington get it right, it's been a leader before. Hewlett-Packard, God knows why it would be on this list, except for the fact that they're talking about Oracle maybe buying it, I think, for its services business. Now, in its defense, it sort of did what I want to see Intel, or so the others do. It got above this moving average and held. Kahuna, good volume. You can see the group rank, or the group performance is heading north. No earnings per share rank. It's been a dog. It's still in a downtrend. I'm not interested. One of the leaders for the year has been this guy, and you can see the difference between the Intel, the HP, and now looking at 3D systems. If I remember correctly, it is number 2 on performance last year, up 233%. Interestingly, it was up 142% in 2010 and kind of flat in 2011. Certainly in an uptrend, it's near the top. You see it got to the top, Ian's golden indicator, and it came back. Not quite at the top here, but not a lot of room to run. Clearly a leader, everything is green. It makes money, it trades at a multiple about its earnings per rate, doesn't pay a dividend. Probably one of the best charts we've seen tonight, although perhaps long in the tooth and due for a pullback if this market pulls back. This is top-down investing. What are the best groups and the best stocks? Pharmaceuticals. I have Abbott, and I didn't just make that up. I've had Abbott for a while. It's hit my target. I have Abbott because of this. I have Abbott because it got a nice 3% dividend, and it had pulled back to the 200-day moving average, and I thought it would run from 62 to 65, or 62.5 to 65, and it has. It doesn't have much earnings per share growth. It's probably in a low-risk buy point. It hasn't been below the 200-day moving average in red since August of 11. Here it knifed it in October, got back up the next day. My guess is it probably doesn't drop much below it. And if you need defensive plays, Abbott has always been a good defensive play. And it's the top of the list there. BMS got a huge approval on Friday of a drug that's safer than Coumadin. Why Hillary Clinton's not on it, don't know, based upon all the hype. Big gap up on Friday from a inverted hammer. Things here are blue. Again, it pays a huge dividend here of 4.2%. I don't like it as much as Abbott because it's below the 200-day moving average. And I'd rather the 200-day moving average be where I bounce to go up rather than where I bounce to go down. So I don't like to buy below the 200-day moving average. J&J, one of my money managers bought some of this on Monday in my account. 3.5% dividend yield, so not a big shocker. Why? A lot like Abbott, sort of a slow, steady upturn, way above its 200-day moving average, nowhere close to the top. And even on a boring drug stock, Ian, you missed out. This could have made you the millions you've been asking us for. It calls the top every time. Now, sometimes the stocks will skate across the top for a while, but you're never wrong in getting tighten stops when you hit the high jump bar indicator. What else is good? Automobile manufacturers, already looked at Ford. I mean, except for the fact it's long in the tooth and getting up to the top, which is not a place to buy. Let it go sideways or pull back. Wow. I mean, what else can you say? Wow. And when you listen to the news, it doesn't sound like it's going to get much worse. It sounds like they're going to have steady, slow growth. Their cars are much better than they used to be. I grew up in Detroit, and they've done a nice job. Winnebago is one that has really had a big run, which is kind of interesting considering the economy. I've been in and out of 4 industries, which despite the fact, and they're in the same business of making RVs, despite the fact that they reaffirmed earnings, they've gotten hammered. Winnebago has not. If I did spread trades or pairs, I might want to short this one and buy the other because I don't get it. This one's up near the top, clearly at a point where you expect it to pull back. The other in the same industry has gotten crushed. I suspect this is why I wouldn't short it. Huge, huge, huge earnings per share growth, and that might be, it's a turnaround stock after losing or lowering earnings, now blasting away. The beauty of this program is I've gone to others for some real-time stuff to make a point, but everything else I'm just doing in the program. So we go through the top 10. I'm going to pick it up a little bit. Now 920, oil exploration. Natural gas got clobbered. Oil's done very well. These guys seem to come alive on Monday. Oil index moved up big on Monday. Here's Anadarko Petroleum, highest combo in the group, and you could see, have pulled back to the 50. It's a good place to bounce from. I don't like lack of earnings per share growth, so some of these you're going to have to pinch your nose and buy them without earnings growth. Plains Exploration's a buyout. I have a little bit of this guy, which had a big day on Friday, but like the rest of them, their earnings growths are putrid, and they've been sort of flatlining. I have to ask Lou Powers via email which one to buy. Communications equipment. Can you imagine Qualcomm and Cisco being at the top of the list? High growth stock 101. I mean, flatline, took out its major indices, certainly a big squeeze with the 50 and the 200 right there, a kahuna on Friday. Momentum all red, not much earnings per share growth, not that exciting, probably rebounded because of Apple and thought that they'd be selling more CDMA, LTE, and other components. Cisco Systems. Cisco's quietly had a decent couple of months from July to now, going from 15 up 25%. You can see why it made the list. Lots of volume, 32 million shares, up 1%. I'm not that excited by Cisco, kind of loose for my taste. Back. System software, see if there's anything here. I'm going to go through 10, then we'll look at the downside, and then I'll look at some other programs and take questions. Here's a stock that was on my watch list on Monday that I got too busy and I didn't buy. I wish I did. It made my watch list for a couple of reasons. Had a pocket pivot on Friday. It was all green. I just liked the picture. Lower left, upper right, in a nice move. China is turning around, and now it's off to the races. Missed that puppy. And you can see here huge volume compared to its average volume day. Oracle. Oracle's become a growth stock again. Ellison's a rich man. 25 up to 33, pulled back to the 17, sets up a natural place to buy it, as it did here, coming down to the 17, mostly green. Slow earnings per share growth, pays a dividend at 2.2%, a lot healthier looking than something like Intel as far as where it's come from. Ninth group down is, I think, Pharma. You have home building. Love this group. Pick one, pick two, maybe pick four. I believe this group will lead again this year, and I've got several of them. And I've got several spin-offs on home building, which I'll talk about. Pulte, nice pullback down here to 17, to the 1750. Big day on Friday. Everything is green. First thing you see here that should be different than almost everything else we've looked at tonight is earnings. These guys make a ton of money. Yes, they're a big turnaround where they had loss of revenue and earnings for several years, bad performance in 2010 and 11. Pullback in an uptrend, everything turned green. Volume, great earnings per share growth. I like it, I own it. Toll Brothers had pulled back deeper, got above the 50-day on Monday rather, with the kahuna. If it can hold that 50, I might be getting back into Toll Brothers as well. Lennar, lower left, upper right, a leader, pulled back to a confluence of moving averages of squeeze and took off again. Great earnings per share growth. I can go through the whole list. Hovnanian, we talked about on my call as a leader. High jump bar hit, pulled back, running again, high jump bar hit, pulled back. I don't think this guy's got a lot of room short term. It's got to go sideways for a while because it's getting very extended. You look at it twice with the 200-day moving averages. But, great earnings per share growth, doesn't make money yet. Turning around now, so it's a little bit behind the others and perhaps got a little bit more ways to run. Other things that I'm playing here. U.S. Gypsum is a play on the housing industry. They make gypsum, which I guess goes in the walls. Kind of looks like a housing stock, doesn't it? Earnings per share growth coming in. Turnaround stock. pull down to the 17, running again. I can't remember what Eagle is. EG, well, we'll find Eagle again. Eagle, which is a cement manufacturer, is another one to like. Lumber Liquidators is another one to like with wood products and paneling. Sherwin-Williams with paint. It's given us a nice sideways time, getting some of the excesses out of the stock, ready to run. PPG, where I may have put money on the short and got out, another paint manufacturer, looks like it's getting ready to run again. So as a lot of pinball action, as Kramer would say. Biotech. If I had to pick long-term, I really like Gilead. It's got a big franchise in HIV. It's got some hepatitis C and some cancer drugs coming. Earnings per share growth picking up back half of the year at a nice time to buy, pulled back to the 50. This is, look, it bounces off the 50, it goes up. It bounces off the 50, it goes up. It bounces off the 50, it goes up. I like it. I own it. I continue to own it. If tax gain selling is abated, I expect this stock to move up. This is Regeneron. It's got huge earnings per share growth in the cancer space. The other one, which could be a shorting, if the market rolls over, these are also short candidates, by the way, because they're very extended. This one is not nearly as healthy looking. Alexion was a great leader. Go to weekly, show you what a leader looks like. Leader, setting up a head and shoulders here. If it can't get above and stay above that 50 and turns down, this is one you could ride down for a big short gain if the market rolls over. And you know where to put your stops. You could put a stop right above the 50. But again, I expect to see another day like Monday if the signature comes to tomorrow, and I wouldn't be shorting anything until we get a sense from momentum that the market's rolling over. Let's look at where the market's not working well. Let's go to the dark side. None. So no groups had a negative force index on Monday. Now, I've mentioned several times I don't like shorting individual stocks. I do from time to time. I do puts fairly often. But what I do like to play with are some of the ETFs in the marketplace, and I'll look at them on a different program. And if I think the market is going to roll over, then I'll start to look at the 3X bulls and bears. And let's do a real quick thing here if I can. So some of my favorites, if I think the market, I will look at them and look at the charts, but if I really want to play seriously, I look at shorting some of the 3X bulls or buying puts, which is how I'd rather play a short, if I think the market is going to roll over, or buying some of the 3X bears. So rather than naked shorting, I would prefer, because the risk is better for me to buy puts or to buy contra ETFs. And you all know what they are. I don't have to tell you where they are. And you can see what would have happened to you if you were in contra ETFs on Friday. Now, show you a couple other things before I open it up and say goodnight. During the day, I've been scanning the S&P 500 and then the high volume stocks looking for green candle lows. And you can see Abbott, everybody had one on Friday. There's so many. And it's something worth going on the internet. David Elliott talked about them the most. in learning about those. They're not difficult to program. I've given George the formula and asked him to start working on it within HGSI because they seem to be a very nice tool for helping to identify changes in momentum, both the green candle lows and the red candle highs. Go back into HGSI. A couple other things. Ron did a nice example of this today, or rather today, on Sunday in his weekend review, and that was the use of the group inclusion report. So I'm going to very quickly show you a shortcut. We'll find 10 stocks to look at, and then I'll see if there's any questions.
There's a few sitting in the chat box, Jeff.
Perfect. So in the group inclusion filter, tools. All right, Jeffrey, go to designer. How long have you been doing this for? Tools, group inclusion report. Clear. Let's go up here into smart groups. So these are pre-done groups. I've mentioned Gil Morales, Chris Ketcher, and their pocket pivots multiple times. This is one of the few programs that they've actually authorized and worked with to set it up correctly that identifies pocket pivots. So I'm going to look for, do a group inclusion report, look at pocket pivots, best criteria, ERG 240, growth, HGS 100 leaders. So these are my favorite bullish smart groups. So smart groups are pre-planned searches built in the program. And if a stock is strong, it gets into one of those groups. So then if the stock is really strong, it might be in many of the groups. So if I can find stocks that are in the most of the different smart groups, then they might be the ones to go look at just before we say goodnight or before I go answer questions. Just call it ABC. So what this will do real quickly is it's now identified which stocks make it into the majority of the list. So this is more bottom-up investing, but let's take a look at the top 10. Few comments. Building stock, Automan, this seller, we looked at 3D System. Terex is a building stock. M&I Homes, Louisiana Pacific's a building stock. Pulte, Hovnanian, do you think building stocks are strong? Yes. So let's go into the program. We should be able to see a group that I just created with a lot of A's. And it's go into scorecard no index. It should have a few stocks there. It's got 10, which is what I asked it to get. These were the top 10 from those lists. I'm going to go through very quickly. I don't know what to do with this guy. I talked about it on Saturday or Sunday. It's clearly had a nice run up. I don't get it. Why would I want to make my own soda when I can buy 4 12-packs for $11 and not deal with the hassle? Well, obviously someone likes it. It's a relatively small, $500 million a year run rate company. It does make money. It trades at a multiple of 22, no dividend. It's in a nice little run from 33 up to 45. It's skating near the top of the high jump, so it's not for me. The multiple is 22, as I said. It's got a higher growth rate, so it's attractive. It grows faster than its multiple. I think it's extended, and frankly, I don't get it. Seagate, it's one of the other things I don't get. I own it. I'm in and out of this stock. It had the world's greatest fundamentals, and the stock traded at a PE of about 4. Now the fundamentals are getting worse. We'll see if the PE goes up. It and Western Digital are the same thing. If semiconductors and computers do well, these guys will probably do well as well. They had a pocket pivot on Friday. Can't see much on volume because 6.5 million shares were traded. Everything is green. As I said, I'm already in the stock, and if I wasn't, I'd be buying it now based upon the chart, based upon its earnings, and based upon the fact it trades at a multiple of 3.9 and pays a 5% dividend. By the way, if you like the 5%, if you bought it last month, it paid 6 because the stock's appreciated. Oh, speaking of the devil, if you like one, you got to like the other. Western Digital, these things are wildly volatile. They're probably good trading stocks in a swing, not holding them for the rest of your life. 2.4% dividend here. Again, a multiple here of 4.8. Earnings growth is slowing, but it still makes a ton of money. If you look at historical PEs, they're trading at lows. Terex, I mentioned, is one of those pinball. This is machinery that has to do with building, but also mining. They've done extremely well. You can see it makes good money, good earnings per share growth, trades at a multiple of 15 and a growth rate, 50 dropping to 30. Lower left, upper right, Kahuna, good volume on Friday, pulled back to the 17, running again, probably continues to run. Lithium Motors owns a lot of auto retail. Since the car industry is doing well, someone's got to sell the cars. Sort of a kind of a rocky saucer bottom here. Pull back to the 50-day moving average. Everything turned green. Big volume. Looks like an attractive time to buy that stock. If you're building a house and you have any money left, you've got to buy a home entertainment system and appliance. Kind of interesting with the demise of CompUSA, Circuit City, the struggles of Best Buy. I've been in these stores. I don't get them. This guy's leading. And look at this, lower left, upper right, great earnings per share growth, although it looks like it might be slowing down. Trades at a multiple of 21, doesn't pay a dividend. Looks like it's running again. We already looked at 3D Systems. CalAmp, I talked about this on one of my calls. I was interested in here when it ran up to the 50. I said it had to break above the 50. I liked the earnings coming into the stock. I was a little bit nervous there. It failed at the 50. I wouldn't touch this puppy until it closed above the 50 and held, because right now it looks like that 50 is resistance. Ryland Group, we've looked at other housing stocks. Look at the earnings per share growth. In a market that has almost no earnings, these guys are true leaders, lower left, upper right. You want to buy it when it gets close to the 50 and sell it when it gets extended. It's sort of in the middle right now. Great growth rate, one to be on your list. Cynosure is I think a laser company in healthcare. Bongos are red. I'm probably not too interested yet. I'd like to see the weekly turn green. Pull back to the 200. Now it's sort of in a squeeze with these all coming together. A break above it would be interesting. One thing I've been finding, and note to George, the second quarter out, which has always been questionable, is very questionable now. There's a lot of zeros in the database. So I would go somewhere else like MarketSmith and see if the earnings are actually growing or not. If they're growing at this rate and that's not a zero going forward, trades at a multiple of about 40, something to watch, especially if it breaks above the 50. And that's my quick run. So we go back to my PowerPoint for a second. And I won't bother if it's already closed. I've looked at GIFs. I've looked at top-down. I've looked at some of the other ways that I make my stock picks. Let me see what questions have come in. Yeah, the Guppy, the multiple GM, oh God. I got the TV in the background and they just had Betty White's face photoshopped onto some 20-year-old model's body in a bikini. I got to turn these garbage shows off. Speechless. I have used the GMMA. I've got it on a number of other programs that I use, including HGSI. The GMMA is, I think Guppy was the name of the guy. He basically, and I'm just going to put some, I don't even know what stock to put on it. Let's look at Watson. Let's see if I can go find the GMMA chart. So Watson is actually a frustration for me. I'm out of the stock now. It had been a leader. It looks like it wants to take a break, and it's lagging. And you can see it was one of the few stocks that actually had a crappy day with a pocket pivot down on Monday, despite the market being so strong. Oh, let's see if I can even find it. I'm going to give this a second to see if I can find it. If I can't find it, then it's something I'll do on another, I guess. This is not it, but it's used a similar way when you look at a band of moving averages and you look for them to shift their representation, meaning that the market, he squeezes here, see the green is flipped down, which tells you it's trending the other way. When they flip back around here, you got an uptrend. You use it to get out. And what the Guppy chart does is it does a similar thing, but it does it on a number of other, I haven't looked at it in so long, it uses a whole lot of different moving averages, which gives a really interesting picture. We used to call it the Manu chart. Sorry, Manu, I know you're on the call. I forgot where your chart was. But it could be a nice way of getting in and out. To me, it's a little bit slow. Answer that. No. The high jump bar is, let me open up a chart. I can't say enough good things about the high jump. You could probably tell that. So let me go into the program. This is the only program I've ever seen that actually includes this in the program. So the high jump bar takes your closing price, which is whatever, and subtracts the 17-day, takes your closing price and subtracts the 50-day, takes your closing price and subtracts the 200-day, adds them together, and that gives you a number, which is 41.61. The high jump 17 is between the price and the 17, the price and the 50, the price 20. You add those up, you get your 41. And so it's not a moving average. It's the price minus the moving average, and you add them together. And you could see, you could actually chart each of the moving averages, but most of the work that I've done and that I followed really only relies upon the sum of all of them together. So it's the distance between the moving averages added together. You think about it, how far from the 200-day moving average can you get before the stock's going to correct? And it's just another way of looking at it. Thank you. Thanks, Cliff. One of the other stocks that has been a nice play, Eagle Materials. Again, this is another, every one of my webinars I've said to buy this stock. And I know I sound obnoxious. I guess it's speaker's prerogative. But, I mean, is this not the tightest lower left, upper right since the end of June you've ever seen? And every time it got to the 50, we were saying to buy it. Look at the earnings per share growth. Look at the multiple. Buy. Still buy. You know, I said this a lot on this guy, and this was the #1 performer last year and great 3 years in a row. It doesn't look so hot right now because it's had a little bit of a correction. Don't you want to own one of these guys? Now you probably don't because it looks like it's going to set up the head and shoulders sell. But there's some really great stocks which argues for the finding great stocks, not just doing the tops down. So I do it both ways. What are the pink and blue bars in the price plot window? Those are pocket pivots. So Gil Morales and Chris Katcher, basically they are super guys. In fact, recently got to sit down and eat dinner with them. Chris, smartest guy I've ever met. And I mean, only my son could do 10% of what Chris has done. He's been involved in the discovery of 3 elements. He is unbelievably talented as a musician and brilliant. So a pocket pivot basically you have to have a couple things. You have to have the highest volume that day, higher than the last 10 days, and within the last 10 days, higher than the highest other way volume. So since this was an up day, as long as going back 10 days, there was not a down day with higher volume, it's a pocket pivot. You have to also cross, he looks, I think, at 10 and a 20 and a 50-day moving average. So if you intersect the moving average and you have the volume profile, then it triggers a pocket pivot up. And it's for them a very powerful buy and sell signal is the pocket pivot up. One of the beautiful things about HGSI is that it's one of the only programs that I'm aware of that I could go into smart groups, strategies, Morales, and Catcher, and I can highlight this, and I want to be in a warehouse view, not a ranking view, and I'll get rid of my filter. And I should get a list. These are all the stocks that met their criteria for a pocket pivot on Monday. And they're big believers that these are momentum indicators, as my word, not necessarily theirs, of a stock that's going to move. So Louisiana Pacific is another in the home building. They're forestry, so the wood business. Again, does this Eagle Materials all over again? Lennar, Pulte, and pulled back a little bit. Pocket pivot came in, decent volume day. So I know it's had good volume. I know it pulled back, intersected a major moving average, and I know it's a powerful contributor to an up move. I didn't do justice. I guess I'm a good advertiser for a few things, although, as I said before, I pay for my own stuff, which allows me to, in my mind, have a little bit of credibility. First thing is, if you're on this webinar, I'm assuming you've read O'Neill's book. If you haven't, shame on you, go buy it. It's a great foundation and a core tool. If this is 101, this is 801 and 901. These are the Pocket Pivot Gurus. This is their first book. Here's their second book. Very readable despite the thickness. And they'll show you how they made 18,000% using pocket pivots and a few other tricks. See about any other questions I got. All right, so our energy guru is on board tonight. He said look at EOG and Noble. So let's take a look at EOG. When Lou speaks energy, I look. So a little bit of earnings per share, which the others don't have, pulling back to the 50-day moving average in an uptrend, right the place that I like to buy. Mostly green up here. Good volume came in Friday. I agree. Thanks, Lou. That's much better looking than the Anadarko and the Apache. Noble is I think a driller, isn't it? No, nope, not a driller. And clearly in an uptrend, pulled back, nice move on Friday, not as attractive on the earnings per share growth. Lou also recently wrote a book on reviewing his long career in the energy industry, including a lot of time he spent in Saudi Arabia, a very insightful book on the world oil dilemma. A good read, and he's a very smart person when it comes to energy. I'm just going through the questions I have right now. What was this? Lou. Do I find base counting and pattern breakouts of value? Geez, I've got MarketSmith. when I do my review, I throw all the stocks into MarketSmith. They find some interesting cups and handles, which I haven't seen, and some flags, so I like their pattern recognition feature. Here's the big difference. $500 a year, give or take, gets you HGSI and everything I showed you. MarketSmith is a lot more expensive. HGSI sits on my computer. It covers, it does some things in ranking and some of the other things I've showed you that you don't get from MarketSmith. I have them both because MarketSmith has more fundamental data from the earnings perspective. It has intraday charting I can look at as well. I like a lot of their groups that I can look at, some of their MarketSmith growth group and others. The high jump bar is, you could program it yourself in an Excel spreadsheet if you really wanted to. Oh, and B, maybe I looked at the wrong thing. And I guess you could do it on your own, but that doesn't exist in MarketSmith. I've not seen it anywhere else, and I programmed it into Tradestation because I want to scan for it. But you notice I've done all this work using HGSI. It's not because George is paying the tariff to go to webinar. It's because it's the easiest program. I'm sorry. I may have hit the wrong notable, so I'm looking. No, I don't think so. I think I hit the right one. Okay. All right, I think I've got most of the questions, George. Are there more? How is the leaderboard product? You know, Myrna, you know I have it. I look at it intraday to get updates on what they think the market's doing. They'll make some comments. I may pick up something here or there that makes a difference. I could live without it. I just, as I said before, I've not met a program that I don't like. So a couple other things before I say goodnight. You know, the live meeting in March, I can't say enough about. I go every year because they're great meetings. I always learn something. This little guy here, he's not so little, but it's a little picture, was called by John Bollinger, you know who he is, as one of the greatest analysts of our time, in our era. And he does twice a year a live program. Ron Brown, who has become a key part of the program as well over the last couple of years. The two of them share the front of the room, and some didactic, a lot of interactive, and a lot of forcing you to do your own thinking. Just a great meeting. Those that are going to be at Greg Mills' meeting beforehand, you should think about coming there at the back end of the meeting. I mentioned the website to download the software for free. Last thing I want to do is to show you one quick thing. I mentioned seasonals. I think seasonals matter. Here's more of a reason to like Pulte Home. What I'm looking here is a seasonal chart in Magenta Trader looking at Pulte Home, and actually not Pulte Home, is it PHH rather? Forget the Pulte comment, whatever PHH is. But what I wanted to demonstrate is the strength that you can see. So what you have is, in this here is a price chart currently of PHH. And as you can see, it's in a very narrow channel, but it cycles up and down within the channel. It's in the lower half of the channel. This yellow line is a line that's being plotted by Magenta as being a seasonal performance based upon, I believe, the last 10 years of data. And so this has got a 5-year in yellow, a 10-year in green, and you could see that over 5 and 10 years, they're pretty consistent with where they go. And if you look at, move this up a little bit, here, when I let me get the data, open up the data window. Come on. Press one more time, Windows data. Well, I have no idea why it's not opening up. Let me open it and close it because I did want to show you one thing there before I say goodnight. Not only do I want to find stocks that are fundamentally strong, they have attractive chart patterns, but I'd also like to know how they've done at similar parts of the year in the past. So that was PHH. Let me just, PHH. And so first thing I notice here is that, it's sort of correlated pretty well with what seasonality would have predicted the price to do. And it's in a period of time where it's below the midline. It's in the process of cycling up, so I feel good that that wind is behind my back. And then I see this green bar here. In fact, let me make this 30 days performance, not just 10. And over the next 30 days, the stock historically goes up. So if I open up the data, and if it doesn't work this time, I'll shoot myself. I don't know what I'm doing wrong. Well, what it would tell you is year over year what the, I don't understand why it's not here. I guess I don't like to, here it is. All right. So it shows me between, let me just change this to 30 like I did before, is it tells me that between December 26th and February 5th, in the last 10 years, it's been up 9 out of 10 times with an average return of 10.11%, and the biggest drawdown was 0.23% over that entire period of time. Between March 1st and April 11th, it's up 7 out of 10 times, and with a return of 13.64 and a drawdown of 2.45. Over the next 5 days, it's up 17% over the last 10 years, 23% in the next 10 days. And you can see the ranges here. It's had no down days. So if I want to buy a stock, don't I want to buy a stock that seasonally is strong too? And I'm just curious, what does this look like? It probably look like the biggest dog, but this is on the fly, folks. So if it has fleas, it's probably still going to go up. PHH Corp, loose, the lower left, upper right, pull back to the 17-day. I probably wouldn't have looked at it because the earnings are not that exciting. Trades at a multiple of 7. It's in the specialized finance, mortgages. Now that gets me interested. Believe it or not, the world has changed. Mortgages sound good. Why not? I know that this stock has been up, as I mentioned. Would you stop that already, Jeff? It's already open once. It's been up 9 out of 10 times in the last 10 years over the next 30 days. Those are pretty good odds. I use Magenta to do a couple of things. I could actually screen for stocks like that as well. And I'm not going to do it tonight. It's one of the things I do routinely when I do my Sundays every once in a while. Maybe I'll spend some more time on it. But I like stocks that are seasonally strong as well. And not only will I run my picks through MarketSmith, I usually run it through Magenta to make sure I'm not going into what is typically a really bad time of the year. Yep, thanks, Joseph. All right, so, am I a fundamental guy or a technical guy? I'm a pretty technical guy because I think technicals lead the fundamentals. So I'll just look at one more thing before we say goodnight. I keep saying that. My wife knows when I get on these calls I'm not coming off until George takes me off. Close your eyes, don't look at anything here. So HGSI is giving me 2 quarters. Don't do that to me. So why do I have to have MarketSmith? And if it doesn't open up, oh. No. My problem now, open link in new tab. Well, what was pointed out by someone else is that huge earnings are coming into the stock in 2013. Let me just try it in a different browser and see if I can get it to work there. Any other questions, George, that you think I need to get to before I say goodnight? You still with me, George?
Yeah, you're good. You're good.
All right, so let me just look at this and then
there is one of interest. It's back up a little bit in your list there, Jeff, about do you find base counting and pattern breakouts of value? Market Smith has a pattern recognition thing.
No, I think high jump that's where I would use the high jump instead. It's a lot easier for me. There's no question that late stage breakouts fail. And so if I see a stock that's in a fourth or fifth stage breakout, I know that that's at higher risk. That, you know, and that actually is a great question, but that's also the same stock that is at a point where it's going to roll over anyways from the high jump. I have a problem with my Internet Explorer tonight, and the other guys are giving me script error, so I'm not going to open up Market Smith. So I think on that note, I'm tired. I'm sure you're tired of hearing from me. If not, this will be up so you can watch it again as a recording. Everybody have a happy New Year's. I'll do it live again in a month. I'll be my Sunday recordings as usual. One last thing to remind you is on the website of highgrowthstock.com, I now have my own little home. So if you are inclined to go there, my weekend reviews are placed there, and they don't come with advertising. You see, George, what's happening?
I see it, but that's not me.
That my browser has been stolen by somebody, so I got to fix that. All right, guys, have a great night, safe trading, and don't let the market bite you on the way out. Take care, guys. Bye-bye.